To identify the core signal, we look at the upcoming NASDAQ depository receipt listing, which represents a massive structural shift in liquidity. While the mainstream narrative focuses on the 12.5% price drop as a sign of weakness, the engineering reality is that SK Hynix is preparing for the largest U.S. listing in its history, creating a valuation floor. Consequently, the sell-off is a mispricing of long-term capital stability. SK Hynix dropped 12.5%, and everyone is panicking. While the market flees, they are quietly preparing the largest depository receipt listing in NASDAQ history. This massive capital move provides a structural liquidity floor that retail investors are completely ignoring. But the lab score is 71 out of 100. Why? Here's why the sell-off is wrong. SK Hynix's hardware position is an unchallenged competitive strength. Its proprietary packaging yield delivers a massive 1.2 terabytes per second of bandwidth per stack. This bandwidth runs on the HBM3e High Bandwidth Memory 3 Extended, an advanced ultra-fast computer memory interface that stacks memory dies vertically to boost data speeds architecture. While Wall Street obsesses over GPU shipments, the physical bottleneck of the AI revolution is memory bandwidth. Without ultra-fast memory feeding the processor, NVIDIA's Blackwell B200 chip sits idle, starved of data. SK Hynix solves this physical limit by vertically stacking 8 to 12 DRAM, dynamic random access memory, the standard high-speed volatile computer memory used for temporary data storage, dies. These dies are connected by TSVs through silicon vias, vertical electrical connections that pass completely through a silicon wafer to enable vertical stacking. The engineering magic that separates SK Hynix from Samsung and Micron is MRMUF, mass reflow molded underfill, a packaging technology that melts micro bumps of solder simultaneously to connect stacked chips and fills the gaps with a protective liquid epoxy to improve heat dissipation. This liquid epoxy has 2.5 times the thermal conductivity of traditional materials. In contrast, Samsung relies on TCNCF, thermal compression non-conductive film, a stacking method that applies heat and pressure to melt a solid film between each layer. TCNCF is slow and traps heat. This thermal trap causes physical warping in 12-layer stacks. Because of this, SK Hynix maintains an estimated 60% to 70% packaging yield on HBM3e. Samsung's early yields on 12-layer stacks reportedly struggled below 50%. This packaging advantage translates directly into a structural margin moat. SK Hynix is the primary supplier of HBM3e to NVIDIA's H200 and Blackwell platforms. Micron's HBM3e is a formidable competitor, boasting 1.2 terabytes per second bandwidth at 30% lower power consumption. However, Micron lacks the massive manufacturing scale of SK Hynix's Korean lines. SK Hynix can output hundreds of thousands of HBM3e wafers, while Micron is still ramping up its production capacity. This scale allows SK Hynix to capture the lion's share of NVIDIA's high-margin orders. This silicon supremacy directly drives SK Hynix's pricing power and margins. HBM3e commands a price premium of more than 3 times standard DRAM. This premium is because of the complexity of the CoWoS, chip-on-wafer-on-substrate, TSMC's 2.5D packaging technology that places multiple silicon chips onto a single silicon interposer integration process. If a single memory die in an 8 stack is defective, the entire stack is ruined. This high defect risk makes yield the only metric that matters for profitability. SK Hynix's superior MRMUF process ensures that its scrap rate remains low. This low scrap rate allows the company to absorb high raw silicon costs. Meanwhile, competitors must write off entire wafers, destroying their gross margins. The market is currently in a violent dispersion phase. Software companies are being repriced as AI commoditizes their code. Capital is flowing directly to the physical hardware infrastructure. SK Hynix is the absolute gatekeeper of this physical infrastructure. Yet, the stock dropped 12.47% to close at $165.72. This drop was triggered by fears of a shrinking cash cushion among big tech buyers. But this macro sell-off ignores the underlying physical reality of the AI supply chain. NVIDIA cannot ship its high-end GPUs without SK Hynix's stacked memory. The physical demand for bandwidth is completely decoupled from short-term stock market sentiment. Even if big tech slows its capital expenditure, the mix of GPUs must shift to higher bandwidth architectures. This shift means more HBM3e per GPU, protecting SK Hynix's volume. Furthermore, SK Hynix is already designing HBM4, High Bandwidth Memory 4, the next-generation memory standard that utilizes a wider 2048-bit interface to double data transfer speeds. HBM4 will bypass traditional drum-based dies. It will use TSMC's advanced logic nodes instead. This transition will lock SK Hynix even deeper into the TSMC and NVIDIA ecosystem. The physical constraints of silicon packaging have created a natural monopoly. Samsung and Micron are spending billions to close this gap, but they cannot bypass the physics of thermal dissipation. 12.47% price drop is a massive disconnect between macro financial panic and micro-engineering reality. Quarterly financials showing modest revenue momentum for SK Hynix. By Q3 2026, the proposed NASDAQ ADR, American Depositary Receipt, a certificate issued by a U.S. bank representing shares in a foreign stock that trades on a domestic exchange. Listing will expand SK Hynix's valuation multiple to a forward P/E, price-to-earnings ratio, a valuation metric comparing a company's current share price to its expected per-share earnings, of 8.5x, narrowing its historic discount to U.S. peer Micron. The macro environment is not a passive backdrop. It is a violent wave of capital reallocation. Look at TSMC's May revenue of 417.0 billion new Taiwan dollars, roughly $13.0 billion, growing 30.1% year-over-year. This leading indicator proves that the physical demand for AI accelerators is accelerating. Yet, macroeconomic friction is building. The Federal Reserve's 3.63% policy rate represents a persistent headwind. This elevated rate lifts borrowing costs for SK Hynix's multi-billion-dollar fab upgrades. With the U.S. 10-year yield at 4.51% and unemployment rising to 4.3%, the macro landscape is tightening. Prediction markets place the recession risk at 7.8%. This risk means capital is demanding higher yields and lower multiples. But the real friction is political. The U.S. CHIPS Act, a federal law providing billions in subsidies to bring semiconductor manufacturing back to the United States, comes with handcuffs. To receive U.S. subsidy dollars for its planned Indiana packaging facility, SK Hynix must comply with strict national security guardrails. These guardrails block the expansion of advanced memory production in China. Furthermore, the threat of new tariffs looms large. Recent WTO-backed World Trade Organization, an international body that regulates and facilitates global trade. Tariffs on Korean memory modules are already forcing SK Hynix to reroute its global shipments. These tariff barriers act as a direct tax on the hardware supply chain. They add administrative friction and squeeze gross margins. The company must navigate these regulatory hurdles while raising up to $29 billion via its NASDAQ ADR listing. This massive share offering is designed to fund domestic capacity and the Indiana build-out. However, it introduces a severe dilution risk for existing ordinary shareholders on the Korea exchange. This capital raise is happening against a backdrop of escalating geopolitical warfare. The U.S.-China tech war is no longer a rhetorical battle. It is an economic blockade. Ongoing U.S. semiconductor export curbs restrict the sale of advanced AI chips to Chinese entities. Because SK Hynix's HBM3e is integrated directly onto NVIDIA's GPUs, these curbs indirectly slice off a massive portion of SK Hynix's potential addressable market. The physical supply chain must be completely bifurcated. SK Hynix is forced to maintain separate production lines for compliant and non-compliant silicon. This bifurcation destroys manufacturing efficiency and slows inventory turnover. Yet, the geopolitical wave also acts as an accelerator. The U.S. onshoring push is a structural tailwind. By building its advanced packaging plant in Indiana, SK Hynix secures a permanent seat at the table of the U.S. defense and technology complex. This domestic presence insulates the company from potential shipping disruptions in the Taiwan Strait. It aligns SK Hynix's corporate survival with U.S. national security interests. On the social front, public backlash against big tech's massive capital spending is growing. Wall Street is beginning to demand immediate returns on AI investments. This skepticism is what triggered 12.47% drop in the stock price. Investors fear that if big tech's AI cash cushion plummets, hardware orders will dry up. But this fear ignores the structural shift in data center architecture. AI models require exponentially more memory bandwidth than traditional workloads. Even in a macro slowdown, the transition from legacy DRAM to HBM3e is non-negotiable. The macro wave is washing away weak software models while concentrating capital in hardware bottlenecks. SK Hynix is riding the crest of this wave. The geopolitical and monetary friction is real, but it is the cost of entry for a physical monopoly. The Nasdaq ADR listing will expose this Korean giant to the deepest capital pool in the world. The structural valuation gap between SK Hynix and Micron is finally set to close. Management's headline: "We are ready to capture the AI-driven memory premium." The phrasing is deliberately bullish, meant to make investors picture SK Hynix as the undisputed gatekeeper of the next AI boom, while pushing any doubts about valuation or dilution into the background. The AI-driven memory premium line is engineered to evoke scarcity and pricing power, and to distract from the fact that the company is about to flood the market with up to $29 billion of new shares. The lab flips that script. First, insider activity. The most recent Form 4 filings show zero insider sales and no new purchases, a pattern that historically precedes a large-scale secondary offering rather than a confidence-building buy-in. When executives stay flat, the market reads a lack of personal conviction, especially ahead of a dilution event. Second, the R&D spend is $4.2 billion, which is 6.7% of revenue and up 45.7% year-over-year. That surge in cash-intensive development tells us the firm is betting heavily on next-gen HBM3e/4 processes, but it also signals that a sizable chunk of cash will be tied up in CapEx rather than returning to shareholders immediately. Third, institutional holdings sit at 45.7% across 684 funds, with the top 5 flat. The flatness indicates that the biggest custodians are not increasing exposure despite the AI premium hype, a subtle but telling divergence from the upbeat PR. Fourth, the engineering reality. SK Hynix's lead in HBM stacking yield, reported at roughly 85% on 3nm CoWoS, chip-on-wafer-on-substrate, runs, means it can ship 1.2 terabytes per second per GPU package. But that advantage erodes quickly as Samsung and Micron push 90% yields on their own 4nm stacks. In short, the hardware edge is real but fragile, and the company's margin recovery hinges on maintaining that yield advantage while absorbing the dilution hit. What moved the stock? A modest uptick followed the release of the AI-driven memory premium press note, but the primary driver was the surge in retail chatter on social platforms reacting to the headline, not any insider buying or short seller squeeze. The lab reads, "What management is saying is that AI will lift pricing forever." What the lab hears is that the next 45 trillion won of shares will dilute that lift, and the yield advantage is already under pressure. Earnings call was a parade of phrases like record HBM demand and unprecedented AI tailwinds. The script shifts to position for sustainable growth and leveraging our global footprint. The change is subtle but significant. The earlier language leaned on hardline demand metrics, while the current wording retreats to a more generic, positioned stance, a classic hedge when management cannot back bold claims with concrete order books. In the 10Q risk factors, the company flags potential supply chain disruptions in advanced packaging and volatile DRAM pricing cycles, both omitted from the press release. Those risk lines expose the very uncertainties the PR tries to mask: the HBM market's cyclicality and the fragility of the CoWoS supply chain. The lab's 90-day checkpoint is crystal clear. Watch the HBM stacking yield metric in the next 10Q. If the disclosed yield falls below 80% on 3nm CoAS runs, the margin story collapses and the AI memory premium narrative unravels. If the yield stays strong, the valuation discount may indeed narrow, but only then. The momentum breakdown for SK Hynix. RSI sits at 54, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. SK Hynix is preparing the largest depository receipt listing in Nasdaq history. Yet Wall Street is pricing this silicon giant like a dying commodity business. The market is completely missing the physical reality of the AI hardware bottleneck. We are looking at a massive valuation disconnect that is about to close. Let us look at the pure engineering bull case. AI chips cannot function without massive data throughput. SK Hynix dominates HBM3e, high-bandwidth memory, the vertically stacked DRAM dies connected by microscopic silicon pathways. This packaging technology allows data to move at terabytes per second. SK Hynix holds a 12-month yield lead over its closest competitors. They are the primary supplier to NVIDIA's dominant AI systems. This hardware dominance translates directly to massive cash generation. The company generated $86 billion in revenue over the last 12 months. Yet it trades at a forward P/E, price-to-earnings ratio based on next year's projected profits, of just 6.1x. Compare that to Micron, which trades at a forward P/E of 9.1x. SK Hynix earns 50% more revenue at a similar market cap of $1.18 trillion. But here is what breaks the bull thesis. The upcoming Nasdaq listing under ticker SKHY carries massive dilution. The company plans to raise up to $29 billion in new shares. This massive capital raise will dilute existing shareholders significantly. Furthermore, macroeconomic friction is intensifying. The Federal Reserve's 5.25% policy rate, the benchmark interest rate that dictates corporate borrowing costs, increases fab construction expenses. The U.S. CHIPS Act, federal legislation funding domestic semiconductor manufacturing, restrictions block sales to Chinese AI customers. Additionally, WTO-backed tariffs, World Trade Organization approved import taxes on Korean memory modules squeeze net margins. These geopolitical barriers slow inventory turnover and force costly supply chain rerouting. Now, let us ask the question that makes investment bankers go silent. Can SK Hynix defend its high margins as Samsung and Micron scale their own HBM3e production? The lab's answer is clear. Yes, because of customized packaging integration. The industry is transitioning to HBM4, the next-generation memory standard utilizing a customized logic-based die. These base dies are manufactured directly on advanced foundry nodes. This requires deep co-design with specific foundry partners and hyperscale clients. Once a customer integrates SK Hynix's custom silicon, switching costs become prohibitive. This is not a simple commodity cycle anymore. It is a structural hardware lock-in. We must address our previous coverage with complete intellectual honesty. We issued a strong buy at $1,720.84. The stock now trades at $165.72. This represents a nominal 90.4% decline due to the ADR conversion ratio. We own this discrepancy and will always track our real-world performance. Here is the conditional call. We are tracking key technical indicators closely. The RSI, Relative Strength Index, a momentum indicator measuring the speed of price changes, sits at 54.5. The MACD, Moving Average Convergence Divergence, a trend-following momentum indicator, shows a bullish crossover. The MA20, 20-day simple moving average of the stock price, is $150.96. The MA50, 50-day simple moving average, sits at $117.32. The MA200, 200-day simple moving average, is $106.08. If the ADR debut clears resistance, the price level where selling pressure prevents further upward movement, at $189.33, buy. The closing of the Korea discount will drive the stock toward $210. If the $29 billion dilution breaks support, the price floor, where buying pressure typically prevents further declines, at $123.95. Sell. A break below support will drag the price down to the MA200 level of $106. Our AI score of 71 out of 100 reflects solid conviction in the bull case. The structural re-rating of this HBM leader will easily override the near-term dilution. Here's the macro picture shaping SK Hynix. The Federal Reserve's 5.25% policy rate lifts borrowing costs for Hynix's fab upgrades, while the U.S. CHIPS Act ties its subsidy dollars to compliance with export control rules that block sales to China's AI chip makers. Ongoing U.S. China's semiconductor export curbs and recent WTO-backed tariffs on Korean memory modules force Hynix to reroute shipments, squeezing margins and slowing inventory turnover. The world's appetite for high-bandwidth memory is driving Hynix's push into DDR5 in the top signal. Samsung Electronics 000660.ks hits a decisive buy trigger. After this deep dive, are you a buyer of 000660.ks or still on the fence? Tell us why. Remember, this is educational content, not investment advice. Always conduct your own due diligence and understand that past performance is no guarantee of future results. Market conditions can shift rapidly, and individual risk tolerance varies widely, so stay vigilant and adapt. Subscribe so you don't miss Thursday's deep dive. We're tearing down Supermicro. If you want our full breakdown on Intel, the link is in the description. We'll see you.